The vehicle deduction is where people lose credibility fast. Either they don't take it at all, or they see something online and they push it way too far. That's why the vehicle deduction has a reputation, not because it doesn't work, but because it's one of the easiest places to expose someone for crazy planning. Your car can lower your taxes, but only if it's treated like a tool, not a toy. In this video, I'm going to show you how a vehicle deduction actually works under the tax code, what the IRS looks for, what methods are allowed, and how to structure the deduction so it reduces tax without running into an audit problem. This isn't about flexing a car, it's about using one correctly. The IRS doesn't care where you drive. They care about the business use, documentation, method selection, and timing. Get those right and the deduction work. Get them wrong and the deduction becomes evidence. There's two legal ways to deduct a business vehicle. Method 1, standard mileage. IRS rate per mile, simple, clean, limited upside. This works well for moderate to minimum track intolerance. Method 2, actual expense. Depreciation, fuel, insurance, maintenance, interest, registration. This is where the leverage is, if the business use supports it. Here's a line that people cross without realizing. Business use must be real, consistent, and defensible. If your car is used 70% for business, you deduct 70%. No rounding, no vibes, no close enough. Mileage logs matter. Calendar matters. Reality matters. Let's run a normal example. You buy a $55,000 vehicle. Business use is 75%. Eligible basis $41,250. Between depreciation and operating costs, you might deduct $15,000 to $20,000 in year one. At a 30% combined tax rate, that's roughly $4,500 to $6,000 less tax. Not insane, not flashy, but repeatable. And more importantly, defensible. Here's what gets people wrecked. Buying a car just for deduction, inflating business use, mixing personal and business without tracking, copying influencer. This is why people say vehicle deductions are risky. They're not risky. Bad execution is risky. Notice the pattern now? The vehicles work because you have a home office, you travel for business, your income is structured correctly. Each move unlocks the next. People who starts here fail. People who arrive here wins. People who plan well, they don't buy cars to save taxes. They buy cars their business already needs, then structure the deductions correctly. That's the difference between planning and playing pretend. If the vehicle deduction feels confusing, good. It should, because it only works after the earlier moves. Next move is the one that changes the ceiling entirely. Not deductions, not expense, not timing. Ownership.